I've come with the last module of income from house property, computation of income from house property, module 7.6. So as you know, the last module we will be doing the problems. So in this module, I have worked out 10 problems covering almost all the adjustments. So when you learn module 1, you have learned the theoretical concepts. Module 2, net annual value computation or NAV computation. Module 3, let out house property. Module 4, self-occupied house property computation. Module 5, pre-construction period interest. Then module 6 is the last module. There we are doing the 10 problems, full problems on house property, income from house property. So 10 problems when you will learn all the adjustments possible I have adjusted. So everything is included in this. So when you learn this problems, you will be thorough with this chapter. And if you are not thorough with one topic, go back to the module where I have explained the theoretical concepts, learn that and come back and do this problem. So it will be really helpful. So this is what I'm going to do. 10 problems I'm going to explain. The first problem, from the following particulars, find out the taxable income of Mr. A for the assessment year 2021. Let out house property was completed on 1/9/14. So let out house property, the date of completion is given 1/9/2014. Then one house property is self-occupied and one is let out. So municipal rental value is there for both the houses. Fair rental value is there. Actual rent received, because self-occupied it is not available and not applicable also. Municipal taxes 1,200, 2,400. Ground rent 500 and 2,400. See, ground rent and all, they will claim that we are not going to allow that exemption, because for let out house property 30% standard deduction they are getting. Interest on loan taken for assessment year 2021, 10,000 each. Now interest on loan for assessment year 14-15 to 18-19. See, here you have to remember the concept of pre-construction period interest. The last module I have explained the pre-construction period interest. See, they can, whatever pre-construction period, they can claim for 5 years. This house was completed in 1/9/14. So then they claim for 5 years already. So now we are talking about assessment year 19, previous year 1920. So they will not get that. So that I will, when I will explain, I will explain that 14-15, 15-16, 16-17, 17-18, 18-19. Now we are talking about 1920. So that will not be applicable. See, 1/9/14 meaning the date of claiming 31/3/13. Till then they can claim that. Till then it will start from 31/3/13. So pre-construction period will end with 31/3/13. So 5 years already completed and they are not eligible to claim the pre-construction period interest. Now fire insurance premium, there is no point in claiming that, because let out house property anyway they will get 30% exemption. Income from other sources is 50,000. So the advantage is total income also we can see that with that. Now solution, table showing the computation of taxable income of Mr. A for the assessment year 2021. So this municipal rental value, both the houses I wrote just like that. You can, for self-occupied you can leave blank also. Fair rental value, one is 18,000, one is not applicable. Now actual rent received not applicable. Let out house property is 30,000. Annual rental value, it's nil. For self-occupied house property, up to net annual value is nil. So here municipal taxes 2,400. For let out house property we have to reduce 30,000 minus municipal taxes. You will get net annual value 27,600. Next, less deduction under section 24. You have to remember that self-occupied house property standard deduction is not allowed. Whereas for let out house property, net annual value into 30/100. We have learned in that module how we will calculate let out house property exemption. So 8,280. Interest on loan, both the houses 10,000. Pre-construction period interest I have already explained, they are not eligible, because pre-construction 31/3/13 is the date of completing the pre-construction period interest, because 1/9/14 it's completed. The previous March 31st we will take, that is 31/3/13, 2013. So already 5 years they claim the deduction. Now this year it will not be possible. So now income from house property. So the value is, one is self-occupied, it's 10,000 loss. Let out house property is 9,220 as the profit. Now we can show the total income also because the income from other sources is given. So loss from self-occupied house property 10,000, profit from let out house property 9,320, income from other sources 50,000. So total income is 49,320. So this is the advantage of loss from self-occupied house property. I told you when you start working, you have to concentrate on this. Whatever, if you buy a small house also, you can claim that interest payment, you can bring it as a loss and you can adjust with any other income. It can be salary or any other income or income from other sources. So your tax liability will reduce. So this is the advantage. So first problem I have explained. Now second problem is Mr. M constructed a building on 30th June 2013. It had two flats of equal dimensions and both the flats were given on rent for residential purposes at a rent of rupees 12,000 each. He incurred the following expenses for the flats. Compute the income from house property for the assessment year 2021. So municipal taxes at the rate of 10% of municipal value for both the flats. So 20,000 into 10, 2,000. For both the flats, it's 2,000, meaning each flat will be 1,000. Fire insurance premium at the rate of 2% of municipal value. So we have to calculate that. Values are directly given. Rent collection charges of first flat, 600, we are not going to allow. Repairs and alterations, not allowed. Interior decoration charges, not allowed. Legal charges for recovery of rent for the first flat, not allowed. Interest on loan taken for the second flat, 4,200. Now, conservation says 150 each for each flat. So now here you have to remember we are going to do the problem. So table showing the computation of total income. So two flats are both are let out. So municipal rental value 10,000 each. Actual rent received or ARR. We are using the short form 12,000 each. Annual rental value will be MRV or ARR, whichever is higher, because other values are not there. Standard rent is not there. So 12,000 we will take. Now municipal taxes and conservancy cess we have to reduce from this, because earlier also I have explained that conservancy cess is one type of cess collected by the municipality. So in very narrow lanes and all, municipality or the corporation will be maintaining that. So they will charge a cess for that. So that also can be claimed along with municipal taxes. So we will reduce that, then you will get the net annual value. Now from this, since it's both let out house property, we can claim 30% deduction. Now interest on loan taken for construction of house property. First flat it is not there, second flat 4,200. So income from house property, first one we will reduce standard deduction only. So 7,595. Second flat standard deduction and interest on loan from house property. So you will get total income from house property adding both the values 7,595 and 3,395. So 10,990 you will get. Now problem 3. Mr. J is the owner of a residential house property which was constructed on 31/10/2017 and it was let out from 1/12/17. So you have to remember that 2 months it was vacant for commercial purposes. The other details are commercial purposes, meaning you can claim standard deduction, municipal taxes can be reduced. So municipal valuation 1,50,000, fair rental value 1,80,000, standard rent 15,000 per month, actual rent 16,000 per month, municipal taxes rupees 15,000 paid by tenant. So whatever is paid by owner only is allowed. So 25,000 minus 15,000, only 10,000 will be allowed. Water and sewage benefit tax due. Anything due, it will not be allowed. So 12,000 will not be allowed. Fire insurance premium payable, not allowed. Legal charges for recovering rent, not allowed. Everything we have included in the standard deduction. Whether he will claim it or not, he can claim 30% flat standard deduction. Stamp duty and registration charges not allowed. Now, unrealized rent for the year 1819 amounted to rupees 16,000, but a deduction of rupees 12,000 was claimed. This assessment year, rupees 14,000 was recovered from the defaulting tenant. Compute the income from house property for the assessment year 2021. We have to remember that deemed income from house property also will be there. That is the adjustment for this unrealized rent. I will explain that. So 1819 he claimed 16,000, but a deduction of only 12,000 was allowed in that year. So 4,000 is there. Now this year he is claiming he is getting 14,000. So 14,000 minus 4,000, 10,000 will be his extra income, deemed income from the house property, that I will adjust in this. Solution. So two columns I have provided, one for the let out house property and one for the deemed income from house property. How you are getting 10,000 I have explained. 16,000 minus 12,000. 4,000 was not allowed. This year he has claimed he received 14,000. So 14,000 minus 4,000, whatever was not allowed. That is the 10,000 deemed income. So here let out house property, municipal rental value, fair rental value, standard rent, actual rent, standard rent and all per month. MRV and FRV per annum values are given. Standard rent 15,000 into 12, 1 lakh 80. Actual rent 16,000 into 12, 1 lakh 92,000. So here A, B, C and D, whichever is higher, that will be your annual rental value. So that is 1 lakh 90,000. Less municipal taxes paid by owner. I told you 15,000 is paid by tenant, it's not allowed, only 10,000 is allowed. So net annual value you are getting 1 lakh 82,000. Less deduction under section 24, 30% of 1 lakh 82,000, it's 54,600. Income from let out house property 1 lakh 27,400. Now deemed income from house property I have explained, unrealized rent recovered and allowed earlier as a deduction. So 14,000 minus 4,000, 10,000 you will get. Standard deduction we have to allow here also. So it is 3,000. Now income from let out house property 1,27,400. First house property. Second one, deemed income from house property 7,000. So total income from house property 1,34,400. Now problem 4. Mr. X owns two houses and one portion is let out and the other portion is occupied by him for own residence. The municipal value of the let out house property is 5,20,000 and that of self-occupied house property is 2,60,000. So one will be let out, one will be self-occupied. Computation will be different. Municipal taxes of both the houses amounted to 60,000. So rent received for the let out house property is 60,000 per month. Other expenses of both the houses are the following. Here you have to remember that municipal taxes, both the houses together it's 60,000. So similarly you can see that interest on loan taken for both the houses. Separately it is not given. So we are going to apportion on the basis of municipal value of the house property. See, one house is self-occupied house property is 2,60,000. Let out house property is 5,20,000. So we will divide these two values in the ratio 1:2. That is municipal taxes and interest on loan taken for construction of the house property, because individual values are not given. So insurance premium for both the houses not allowed, 12,000. Annual charge for self-occupied house property, we don't have to consider. Ground rent for let out house property not allowed. Repairs of self-occupied house property not allowed. Interest on loan taken to repair both the house properties, we have to divide in the 1:2 ratio. Income from other sources 2 lakhs. So we can take the total income of the person also. Table showing the computation of income from house property of Mr. X for the assessment year 2021. So one is self-occupied, one is let out. Municipal rental value, self-occupied, net annual value will be nil. So let out house property 5,20,000, rent received 7,20,000. So whichever is higher will be annual rental value 7,20,000. Less municipal taxes. I told you why we are dividing into 2 by 3. Municipal value of let out house property is twice compared to that of self-occupied house property. So 1:2 we are dividing. 40,000 he will get. Let out house property will get. So net annual value for self-occupied house property is nil. Let out house property is 6,80,000. That is 7,20,000 minus 40,000. Now less deduction under section 24. Only for let out house property it's allowed. 6,80,000 into 30 by 100, 2,04,000. Interest on loan, that also you have to divide in the basis of 1:2. Self-occupied property 13,300 and let out house property 26,700. So loss from self-occupied house property is 13,300. This statement is for computing the total income. Income from let out house property 4,49,300. Income from other sources 2 lakhs. Gross total income 6,36,000. So this also you can reduce that. See, income from other sources, we can reduce the loss from self-occupied house property. So your tax liability is getting reduced. Next problem. Problem 5. Mr. A has two house properties and both are occupied by his family members for residence. So here this problem is, always people will claim that I have 3 house properties. Everything is occupied by my family members. Income tax department will not consider that. See, one house, you can advise them whichever you can reduce the tax liability, that they can opt as the self-occupied house property. So this problem is also asking you. See, two house properties is claiming as self-occupied. So which one he can claim as self-occupied? You have to advise them. So advise him as to which house property he has to claim as let out and which has to be self-occupied. So two options we will do in this problem. One option is house property 1 we will take it as self-occupied, house property 2 as let out. Second option is house property 1 you take it as let out, house property 1 you take it as self-occupied. This usually I have seen this question in the question paper. So this problem is important. You have to calculate both the options and wherever you are getting the least tax liability. Because income from other sources value is also there. Wherever you are getting the least tax liability, that option will be acceptable for the taxpayer. So municipal rental value, both the values are there, 2,40,000 and 3 lakhs. Municipal taxes 50% paid, 20,000, 30,000. Ground rent also is there, 5,000, 10,000. Fire insurance premium paid, 10,000, 20,000. Interest on loan taken for the construction of house property, 1,50,000, 1,80,000. Income from other sources. Now, we have to work out this problem under two options. Option 1, house property 1 is self-occupied, house property 2 is deemed to be let out. Second option, house property 1 is deemed to be let out, house property 1 is self-occupied. In the following slides, I am explaining the computation. So, first one as self-occupied. Self-occupied meaning you have to remember that net annual value will be nil. Deemed to be let out, only municipal rental value is there, that we will take it as the annual rental value. Less municipal taxes, you will get net annual value 2,85,000. Less deduction under section 24, only for let out it is allowed, 2,85,000 into 30 by 100. Now interest on loan taken for construction. One is 1,50,000 self-occupied. Second is deemed to be let out 1,80,000. So self-occupied house property 1,50,000 is loss. Deemed to be let out 19,500 is the profit. So total loss from house property is 1,30,500. That is 1,50,000 minus 19,500. Now option 2. We are reversing that. House property 1 is deemed to be let out and second house property will be self-occupied. Municipal rental value is only there. So that will be the annual rental value. 2,40,000 minus 10,000. Net annual value will get 2,30,000. Less deduction under section 24. 69,000. Only for the first property let out we can claim. Self-occupied we cannot claim. Now interest on loan taken for construction of house property 1,50,000, 1,80,000. Now income from house property, first one is 11,000, second one is 1,80,000 loss. So total loss is 1,80,000 minus 11,000, 1,69,000. Now deciding factor, because income from other sources is also there. So you have to see that both the options and see which one is giving least tax liability for the person that they will accept as the self-occupied house property and let out house property. Because two houses, income tax department will not allow as self-occupied. So table showing the computation of taxable income of Mr. A for the assessment year 2021. Loss from house property, first one 1,30,500, second one is 1,69,000. Income from other sources 2 lakhs. For both the cases, taxable income, first one he is getting 69,500, second one he is getting 31,000. So option 2 is selected because that is attracting the least tax liability. First house is deemed to be let out and second house is self-occupied. Now problem 6, Mr. C is drawing a salary of rupees 50,000 per month. He owns two houses, so salary income is also there with a municipal valuation of 3 lakhs and used for his residence, and one with a municipal valuation of 2,50,000 is let out on a monthly rent of rupees 25,000. Other details of the houses are the following. So municipal taxes, both the houses are there. Land revenue 1,52,000. Interest on loan taken for the construction of the house 30,000, 40,000. Fire insurance premium, we are not going to allow that. Interest on mortgage not allowed. Rent collection charges not allowed. Vacancy is there for 2 months. Income from other sources 50,000. Compute the tax liability. So here solution, self-occupied, municipal rental value, just like that I just wrote that, it's there in the problem. You can write nil also. So self-occupied, up to net annual value it will be nil. Let out house property, municipal rental value, you compare with rental value, rent received. So whichever is high will be annual rental value. Now loss due to vacancy, 2 months. It is 25,000. into 2, 50,000 you have to reduce. Annual rental value you will get 2,50,000 less municipal taxes 3,000 you have to reduce, then you will get net annual value. Now less deduction under section 24. Self-occupied it's not allowed, only for let out you will get 2,47,000 into 30 by 100. Now less interest on loan taken for construction of house property, both the houses is there. So first house it will be loss 30,000, second house it will be let out house property, it will be profit 1,32,900. Now full tax liability we can calculate because salary income is there. So this 50,000 is the monthly salary, 6 lakh is his annual salary. Less deduction under section 16. You have to remember standard deduction he will get 50,000. So income from salary 4,50,000. Loss from self-occupied house property. Loss is 30,000. Profit from let out house property 1,32,900. Income from other sources 50,000. So total income is 6,02,900. Now problem 7. Mr. S has 2 houses and the particulars of the houses are given below. Compute the income from house property. Nature of house property. First one is self-occupied. Second one is let out. Rent received nil and 1,72,000. Standard rent 5 lakhs 1,50,000 per annum. Municipal valuation 4,90,000 1,60,000. Fair rent 5 lakhs 1,80,000 per annum. Municipal taxes paid 49,000 and 16,000. Fire insurance premium due. Anything due, otherwise also fire insurance and all we will not allow. We will not allow. Ground rent not allowed. Interest on loan taken during 98-99. So here you have to remember that if it's, see, self-occupied house property, he has claimed 36,000. Before 99, we are allowing only 30,000. So this is the adjustment you have to learn from this problem. Whereas let out house property without any limit, he can claim. Now, unrealized rent is nil. In the case of let out house property, 6,000 is there. So, municipal rent, we are doing the problem. 2 columns. One is self-occupied. Second one is let out. Municipal rental value or fair rental value, whichever is high. Or standard, that value you are comparing with standard rent. And like that you are arriving at the expected rental value, 1,72,000. Unrealized rent is there. You have to reduce. So, you will get annual rental value, 1,66,000. You are reducing municipal taxes, you are getting net annual value. Self-occupied house property, it's nil. Let out house property, 1,50,000. Standard deduction allowed for let out house property. 1,50,000 into 30 by 100, 45,000. Now, interest on loan taken for construction of self-occupied house property, it's restricted to actual amount claimed is 36,000, but we are restricting to 30,000 because the loan is taken before 99. So, let out house property full value we will allow. Income from house property 30,000 loss for self-occupied, 57,000 for the let out house property. So total income from house property is 57,000 minus 30,000, it's 27,000. Now problem 8. R owns 4 houses with MRV of 60,000, 60,000, 55,000 and 1 lakh respectively. Municipal taxes are 10% of municipal rental value. First house is self-occupied and second house is let out on a monthly rent of rupees 8,000 per month. Third house at a rent of 6,600 and in the fourth house he carries on his own business which had an income of 1,51,450. So fourth house property we will not consider, he is doing his own business. So we will not consider that. I provided column but we will show that value is nil. He claims the following deductions. Interest on mortgage for the first house, 2,000, not allowed. Rupees 1,200 paid as salary of gardener in respect of the third house. This you have to remember. We have to reduce this value from the annual rental value. Compute the taxable income. So this is the adjustment salary of the gardener. Now, first house is self-occupied. Income from house property will be nil. Net annual value is nil. Standard deduction also we are not allowing. There is no interest for construction of the house property. So, first house property is nil. Fourth house property, he is carrying on his own business. So, it will not come in this calculation. So, that also will be nil. We are concentrating on house property 2 and house property 3. Actual rent received, 8,000 is the monthly rent. And second house property 6,600. So, that is how we are getting 96,000 and 79,200. Gardener's salary you have to reduce. So, actual rent received is 78,000 in the second case. Now, municipal rental value 60,000 and 55,000. Annual rental value is municipal rental value or rent receipt, whichever is higher, 96,000 and 78,000. Municipal taxes you have to reduce 6,000 and 5,500. You will get net annual value 90,000 and 72,500. Less deduction under section 24. 27,000, 90,000 into 30 by 100, 72,500 into 30 by 100. So you will get income from house property, first house property and fourth house property nil. Second one is 63,000, third house property is 50,750. Now interest on mortgage of the first house property is not allowed. Interest on construction of the house property. Only purchase, construction, reconstruction and all we will allow, not for mortgage. Deduction is allowed for only for interest on loan taken for purchase, construction, repair and reconstruction. Repair you have to remember, even if that loan is taken after 99, if they are taking loan only for repair, only 30,000 is allowed as deduction. Gardener's salary in the case of third house property is deducted from the rent received. Now problem 9. Mr. B owns a house property at Cochin with 3 independent equal units. Other details about the property are the following. Unit 1 is self-occupied, Unit 2 is let out, Unit 3 is own business. Own business we will not consider. So municipal rental value 1,20,000 per annum, standard rent 1,08,000 per annum, fair rental value 1,32,000 per annum, standard rent 3,500 per month, unrealized rent 3 months. So it adjusts that 3,500 per month. Repairs not allowed, insurance not allowed, interest on money borrowed for construction of house property 96,000 it's allowed. Municipal taxes 14,400. Date of completion is 1/11/98. So compute income from house property. You have to remember that this is loan taken before 99. So in the case of self-occupied house property, only 30,000 will be allowed. So that is the adjustment you have to remember from this. So table showing the computation of income from let out house property, municipal rental value, combined property divided into 3 units. So we have to divide the value. So this is municipal rental value divided by 3, fair rental value divided by 3. So whichever is higher you are taking, then you are comparing with standard rent 36,000. So expected rental value 36,000. Actual rent you have to remember 3,500 is the rental value. 3 months unrealized rent. So 42,000 you will reduce, you will get 31,500. Whichever is higher is the annual rental value. Now 36,000 minus municipal taxes. 14,400 divided by 3, 4,800. Net annual value will get 31,200. Less deductions under section 24. 30% you can allow because it's let out. Interest on loan 96,000 divided by 3 because it's for the combined property they have taken 32,000. So the total deduction is standard deduction and interest on loan 41,360. Loss from let out house property is 10,160. That is 31,200 minus 41,360. Now self-occupied house property net annual value nil, deduction under section 24. So I told you since the loan is taken before 99, amount is only 30,000. So we are getting 32,000 is actually the amount of interest, but we can restrict to 30,000. So loss from self-occupied house property is 30,000. Own business annual value is nil. So one interest will be there. For this 32,000 deduction we will get that they can claim in the when they are calculating their business income, they can show it as an expense in their profit and loss account. So total loss from the third, all the house properties together, one first house property 30,000 self-occupied. Let out is 10,160. So total you will get 40,160. So interest on loan taken and used for own business can be claimed as business expense by debiting profit and loss account. So that is 32,000 they can claim in the business account. Now the last problem, Mr. R had inherited a house from his father in 2015 with the condition that Mr. Hari shall pay a sum of rupees 15,000 per month to his grandmother throughout his life, irrespective of the fact that whether he is able to let out the property or not. That we don't have to consider for the calculation of house property. Now, during the financial year 1920, he had let out his house for 9 months at a rent of 60,000 per month. The other details of the house property are the following. Municipal taxes paid by the tenant 6,500. Municipal rental value 6,500 per annum. Insurance premium paid by tenant 18,000. Interest on loan taken for construction 2 lakh per annum. Compute the income from house. Actual collection charges 9,000. Water taxes levied by municipal corporation. This is allowed along with municipal taxes. This is the adjustment you have to learn from this chapter. 7,000. Compute income from house property. Now, table showing the computation of taxable income of house property. You have to remember municipal rental value 6,50,000. Actual rent receivable for the full year 7,20,000. 60,000 into 12. Whichever is higher will be the expected rental value. Now, loss due to vacancy 60,000 into 3, 1,80,000. Annual rental value 5,40,000. Less municipal taxes you have to reduce, and what it is nil. So, water taxes I told you it's allowed. Net annual value will get 5,33,000. Less deduction under section 24. Standard deduction is 5,33,000 into 30 by 100. Interest on loan taken for construction 2 lakhs. So this is how you are getting the income from house property. Income from house property 1,73,100 you will get. So water and sewage taxes, that is the adjustment you have to learn from this. Now, so this is the module I want to explain with the computation of salary income. Please remember that we are completing this module, computation of income from house property. All the theoretical concepts, all the steps for computation of problems, 10 full problems we have worked out, and this will be, and you can see that this is a simple chapter compared to salary chapter, what we have learned. Adjustments are limited, so it's very good and happy learning, good learning. And any suggestions, any feedback, you please feel free to share with me. Now we will move on to the next module, that is income from business or profession. That is also very simple. With your basic accounting knowledge you can learn that. So this I told you, if you complete salary chapter, it's like completed 50% of the income tax syllabus. So other chapters are very, very simple. So only thing is that salary, be thorough with that, and we are doing it in a systematic way, and you will find it really helpful. Thank you. Happy learning. Keep safe. Stay safe. Be healthy and take care of your health. Thank you.